Good morning.
No.
Go to chapter 34, the multiplier. When we talk about multiplier, it's an effect. It means something has changed in one economic factor that brings about changes in other variables. Multiply, I think something has changed, right? It's an increase in one factor, one economic factor, that brings about a change in other economic variables. That's what multiplier is. So here I wrote, multiplier broadly refers to an economic factor that, when changed, causes changes in other related economic variables. This simply means that the money we spend in the economy is not just spent once. It flows through the government, through businesses, our pockets, and back to businesses in various orders. So that means there's a circular flow of income. So whatever we spend, it doesn't just start from us. It starts from a source, which might be maybe government or a business. So definitely, there's always an income, which is an economic variable, that when it increases, it changes other variables. So as soon as income increases, savings might increase. As soon as income increases, taxation might increase. As soon as income increases, consumption might increase. All these are economic variables, which changes as a result of an economic factor that changed, which is what? Income. Do you get what I just said there? So what does it mean?
No, it's something.
I have a class, please. How about that? Does it mean anything?
We need this one.
That's mine.
No.
Don't worry, let me just give it a
Why are you giving me this? Give me the other one.
No, sorry, I'm using it.
I'll bring it back now.
They should always prepare their class too. Everybody should prepare their class.
Yes.
So what I'm saying next is this. So we have this. An economic factor which income is talked about. So if income changes, if your income level increases, your savings might as well as increase. That is the multiplier effect. Taxation might as well increase. That is also multiplier effect. Consumption might as well increase. That's also multiplier effect. So whatever has happened with income that brings about changes in other economic variable factors is called multiplier. We understand what multiplier is here. Great. So, how do we calculate the multiplier? I wrote, the value of the multiplier can be calculated by using a formula involving a number of variables such as taxation, consumption, imports, withdrawals, and their marginal propensity. So that means whenever we have to calculate multiplier, we need to think about their propensity too. So, like I said earlier, whatever we spend is basically from the circular flow of income. So, savings, taxes, and imports represents withdrawal out of the economy. So, this is a multiplier effect. Thank you. This represents withdrawals within the economy. So, these things will not happen if income does not change. So, that means income would change to bring about changes in savings, to bring about changes in taxes, to bring about changes in imports. Imports represent consumption of foreign products. Do we get it? Do we understand, please?
Yes.
Great. So we start with the first one, marginal propensity to consume. What is marginal propensity to consume? This represents an increase in consumption divided by an increase in income. So the extent at which you can spend based on the fact that your income has changed, that is marginal propensity to consume. Do you get marginal propensity to consume? Propensity means the extent, the ability you have to be able to spend. The more you can spend, that will be based on how your level of income changes.
Okay,
Stop writing, please.
Marginal propensity curve.
Consume. Don't say Michelle, you speak in English, please. Marginal propensity to consume is the extent at which you can consume as a result of an income change. Your level of income has changed. So the propensity means the extent at which you can start spending based on the fact that your income has changed. So your income, if your income doesn't change, there's no marginal propensity to consume. So you are consuming more now because your income level has changed. So your income level changing means that your disposable income has increased. That gives you the ability to spend more. That is the marginal propensity. Do we get it? So the formula is changes in consumption over change in income. So this has to change before we talk about changes in here. So this is a factor, which is an economic factor, which brings about a change in one economic variable. Multiplier, which refers to an economic factor that changed, causes a change in other related economic variables. Income has changed. It brings about change in what? Consumption. Are you here? Do you get the point I'm making here, please? Income has changed and it brings about a change in consumption. That is what multiplier is talking about. Do you get the first point here, please? The second one, marginal propensity to save. What is your savings? Savings is the income that you did not spend. Yes or no? The savings means what? The income that you didn't spend. So the extent at which you can save will be based on how much more you have earned in terms of income. So if your income increases, you might as well choose to save rather than spending. Are you with me, please?
Yes.
So your marginal propensity to save is the change in income, change in savings divided by your change in income. So there's a change in your income level, which has increased your disposable income, which gives you the ability to save more. Savings is part of withdrawals within the economy. These three things will happen through the households. But before this happens, income level must change, which is an economic factor. This is a variable, this is a variable, this is also a variable. They changes at every point in time. But their changes will be based on the level of income. That is what we're talking about here. So we are talking about the propensity because it is based on income. Income remains, income remains, income remains, income remains, income is still there, income is still there. But other variables have changed. Import, taxation, savings, consumption. They all changed based on the level of income. Are you with me?
Yes.
Then we have the marginal propensity to tax. For marginal propensity to tax, I wrote this represents the increase in tax revenue divided by the increase in the income that brings about that changes in tax. So if taxes has to change, it would have been as a result of a change in our level of income. Government might want to increase aggregate demand within the economy. To do that, government wanting to reduce the gap between the rich and the poor. To do that, government might impose progressive taxation. So those who earn more pay more. So the burden of tax rests on the shoulders of those that can afford it. So if the income level increases here, tax rates will increase. So a change in the level of income, which is an economic factor, brings about a change in taxation, which is what? An economic variable. That is a multiplier. Do we get it, please? And the next one, marginal propensity to imports. This represents an increase in imports divided by the increase in income that caused them to change. So imports is part of what households will spend on. But they wouldn't spend on it if they don't have income more. So the more income you have, the more disposable income you could have. Stop that and focus here. The more income you have, the more ability you have to save or to spend. So if you want to spend, you might as well spend on foreign goods. Spending on foreign goods represents imports. So as soon as your income level increases, your spending on imports will also increase. This brings about marginal propensity to imports. So MPM is change in imports divided by change in income. Is it clear?
Yes.
The next one is marginal propensity to withdrawals. What does withdrawal mean? Withdrawal means these three things out of the circular flow. This out of the circular flow of income is taken out because it's not part of what we have anymore. It's out of our economy. Savings, when you save money, you don't spend it, right? It's not going to be what you're going to spend anymore. It's savings. It's going to end in the bank. Taxes you pay to government, it doesn't come back to you. Yes or no? Imports, you spend on foreign consumptions, or you give money out to foreign businesses. Does it come back to our economy?
No.
No. So this represents what we call withdrawals. Do we understand withdrawals here?
Yes.
So withdrawal is marginal propensity to withdrawal is change in withdrawals divided by change in income. So as soon as your level of income changes, your withdrawal level increases. So you are taking what? Maybe you have to pay tax, maybe you have to buy some foreign products, or you want to go on tourism. These are imports of services and import of goods. When you spend on these things, they are out of the circular flow of income. So it's not part of our economy anymore. They are withdrawals. So it means we are talking about an open economy, not a closed economy. A closed economy does not have withdrawals. We did circular flow, I think you guys remember. In circular flow, we have the open economy and the closed economy. A closed economy does not involve international trade. An open economy involves withdrawals. But because when we talk about withdrawals, we're talking about international trade, and this involves international trade. Yes or no?
Yes.
Great. So what does this imply? So the formula for multiplier is this. 1 divided by 1 minus MPC, marginal propensity to consume, which is the same as the sum of the marginal propensity to save plus the sum of marginal propensity to taxation plus the sum of marginal propensity to income, to import. So which is the same as 1 over marginal propensity to withdrawals, because savings, taxation, and imports represents withdrawals, which is the same as all this going out of the circular flow. So these things will happen because there is an increase in our level of income. So an increase in the level of income, which is an economic factor, which brings about an increase or a change in other economic variables like taxation, importation, savings, consumption, is called multiplier. Is multiplier clear?
Yes.
Any question about multiplier?
No.
Thank you.